Corporate finance is a subfield of finance that focuses on how corporations handle funding sources, capital structuring, and investment decisions to maximize the value of the business. It serves as the strategic brain behind a company's financial health, balancing risk and profitability to ensure long-term sustainability. Core activities. The discipline is traditionally governed by three primary pillars of decision making. 1. Capital budgeting, investment principle. This involves identifying and allocating resources to long-term projects that generate the highest risk-adjusted return. Tools like net present value (NPV) and internal rate of return (IRR) are used to compare the profitability of different opportunities. 2. Capital financing principle. The activity determines the optimal mix of debt, loans, bonds, and equity, selling a stock, return earnings to fund operations. The goal is to minimize the weighted average cost of capital, WACC, while maintaining financial flexibility. 3. Dividends and return of capital dividend principle. Executives must decide whether to reinvest excess cash into the business or return it to shareholders through dividends or share buybacks. Key aspects of interest rates in corporate finance. 1. Cost of capital. Interest rates determine the expense of debt, influencing the weighted average cost of capital, WACC, used in project evaluation. 2. Risk premium. Rates are proportional to risk associated with the borrower. Higher risk companies face higher rates. Fixed versus variable rates. Companies choose between fixed rates, predictable, stable, and variable rates, fluctuate with benchmarks like the prime rate based on interest rate risk management. 1. Impact on valuation. Higher interest rates generally lower the present value of future cash flows, leading to lower company valuations. 2. Capital structure decisions. When rates are low, debt is often preferred due to tax-deductible interest. High rates may push firms toward equity financing. Time value of money. The time value of money, TVM, in corporate finance is the core principle that money available today is worth more than the same amount in the future due to its potential earning capacity, interest, inflation, and risk. It is essential for valuation, capital budgeting, and assessing investments, ensuring companies account for the opportunity cost of capital. Key concepts and applications. 1. Present value, PV. The current value of future cash flows discounted at a specific rate to account for time. 2. Future value, FV. The amount that investment will grow to over a period incorporating compound interest. Applications. 1. Capital budgeting. Evaluating projects using techniques like net present value (NPV) and internal rate of return (IRR). 2. Valuation. Assessing the worth of assets, projects, or entire companies. 3. Loan or bond pricing. Determining the value of debt instruments and loan payments over time. Return on investment (ROI) in corporate finance is a fundamental profitability metric used to evaluate the efficiency of an investment or compare the efficiency of multiple investments. Calculated as a percentage, it measures net profit relative to cost, assisting in capital allocation decisions. A positive ROI indicates profitability, while a negative ROI signifies a loss. Key aspects of ROI in corporate finance. 1. Application. It is used to assess the performance of projects, asset purchases, marketing campaigns, and overall business profitability. 2. Significance. It helps managers and stakeholders identify which initiatives generate value, allowing them to allocate resources toward high-performing, profitable activities. 3. Limitations. ROI does not account for the passage of time or the holding period of an investment, which can sometimes lead to overlooking opportunity costs. Discounted cash flow DCF analysis in corporate finance determines an investment's present value by forecasting future cash flows and discounting them back to today's dollars using a required rate of return, typically the weighted average cost of capital, WACC. It is primarily used to value a company's projects or assets by evaluating their intrinsic value. Key components and steps in DCF analysis. 1. Forecast free cash flows, FCF. Project the company's unlevered before interest or levered after interest cash flows for a specific period, usually 5 to 10 years. 2. Determine terminal value, TV. Estimate the value of the business beyond the projection period, usually using the perpetual growth method or exit multiple method. 3. Calculate the discount rate. Determine the WACC to reflect risk of the cash flows and the cost of capital. 4. Discount and sum. Discount the projected cash flows and terminal value to present value, PV, and sum them to arrive at the enterprise value.